Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our series on the set of videos on reading the financial statements. 5 of 7. The statement of retained earnings or the statement of owner's equity. Hope you will like, share and a special request to all to don't forget to subscribe our channel. Today's video is all about the financial statement, which is very important for the owners or shareholders of the company. Statement of retained earnings or the statement of owner's equity. This is called by either of the names. Key indicator of financial health. Retained earnings are the amount of profit remaining after a company has paid all costs, income taxes, and dividends. The statement of retained earnings is included to give a clear picture of what happens to the net income of the company. It is often included at the bottom of the income statement, but for clarity, a separate form is the best. This statement is a critical financial document that tracks how a company allocates its net income, whether reinvested for growth or distributed to shareholders as dividends. While often included within the income statement, presenting it separately enhances transparency. Understanding retained earnings. Definition and purpose. Retained earnings present the cumulative profits a company has kept rather than paid out as dividends since its inception. This figure is essential for assessing reinvestment capacity. What is reinvestment capacity? Reinvestment capacity is like funding expansion of the company or the organization, R&D works, that is research and development, or depth reduction, or decreasing the depth of the organization. Second, financial stability. Lenders and investors prefer consistent retained earnings. This is very important point that lenders as well as investors prefers consistent retained earnings. They feel safe in that company or it provides financial stability to lenders and investors. Dividend sustainability. Ensuring payouts doesn't jeopardize growth. The retained earnings formula. The ending balance is calculated as retained earnings ending is equals to retained earnings beginning plus in net income minus dividends paid. Key consideration. Dividends reduce retained earnings. A highly profitable company may still have weak retained earnings if excessive payouts occur. Prior period errors distort results. For example, misrecorded sales in one year that are corrected later can create inconsistencies if not adjusted across all financial statements. Why retained earnings matter? Number one, financing and investment decisions. Lenders and investors scrutinize retained earnings to gauge financial health, whether it's a bank or a common lender. Minimum expectation: at least 2 years of positive retained earnings for loan approvals is required in most of the cases. Red flag: negative retained earnings may signal underlying issues even if sales or profits appear strong. Example: a business with consecutive losses was advised to restructure rather than seek financing. Number two, owner compensation and tax strategy. Some owners prioritize dividends over salaries for tax efficiency, artificially inflating net income. However, bankers adjust for unpaid salaries to assess true profitability. Excessive dividends can starve the business of reinvestment capital. Here we will give a quote: profitability means little if retained earnings are depleted. Wealth must accumulate, not just circulate. Common pitfalls and best practices. Avoiding mistakes. Reconcile beginning and ending balances. Ensure prior period adjustments are applied consistently. Audit interim statements. Unreviewed reports may hide errors until year-end, delaying corrective action. Monitor dividend policies. High payouts can weaken long-term financial resilience. Financial statement integration. Can retained earnings be derived from the cash flow statement? No. The cash flow statement lacks dividend and net income details. Is a separate statement always required? No. Some accountants embedded in the balance sheet or income statement, but audited reports typically separate it. Retained earnings are a litmus test for sustainable growth. Regularly analyze this statement alongside your balance sheet and income statement to ensure profits translate into accumulated wealth, maintain lender and investor confidence, support strategic reinvestment. Pro tip: partner with a qualified accountant to ensure accurate reporting and avoid misstated earnings. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARS. Okay, thank you. Have a great day.